Hello. Today we're going to talk about accounting. We're going to talk about accounting from a managerial perspective. So the first thing we're going to talk about is the difference between managerial accounting versus financial accounting. Financial accounting focuses on providing information to third parties, so individuals primarily outside of the organization. So the focus is on providing income statements, balance sheets, statement of cash flows to investors, for example, Securities and Exchange Commission, and other third parties that are interested in evaluating the performance of the organization. That isn't to say that managers within the organization don't look at the income statement. Of course they do, but the primary purpose is to provide information for third parties outside the organization so that they could evaluate past performance. So the focus of financial accounting is on past performance. The focus of managerial accounting is to provide information so managers and executives within the organization can make decisions so that they can make the right decisions. So there's a difference between financial accounting and managerial accounting. What we're going to focus on now is aspects of managerial accounting. And one of the key aspects of managerial accounting that we need to talk about is the different types of costs. We need to classify costs in a variety of ways, and so we need to be introduced to the key cost terms and definitions. So we're going to talk about now is the three basic manufacturing cost categories. So there are manufacturing costs, which we refer to as product costs, and non-manufacturing costs, which we refer to as period costs. Now, product costs and period costs are different. Product costs are the costs specifically associated with making a product. Those costs are not expensed until the product is actually sold. That's very different from a period cost, which, for example, could be advertising. When we pay the advertising agency $500,000, then we debit advertising expense and credit cash. Now, in that situation, we've adhered to the matching principle. The expense is recorded at the time that it's incurred. However, with product costs, as I had suggested, it's different. We're buying raw materials, for example. Raw materials, or what we refer to often as direct materials, is a manufacturing cost. It's a product cost. Now, direct materials, when we purchase direct materials, we might have to issue a check for $250,000 to purchase plastic so that we could make our product. At that time, we debit raw materials and credit cash for that amount. So, in effect, we're recording the purchase of raw materials, we're recording that expenditure as an asset on our balance sheet. So we're not recording it as an expense. So product costs and period costs are not the same. Now when we talk about product costs, there's three components to product costs, or manufacturing costs. The first is direct materials, second is direct labor, and third is manufacturing overhead. Manufacturing overhead includes indirect materials and indirect labor. So there's a difference between direct costs and indirect costs. Direct costs, like direct materials or direct labor, are costs that we could trace easily to a specific product. Indirect materials or indirect labor is difficult to trace back to a particular product. So, for example, indirect labor would be the janitors that clean the manufacturing facility. So we know that we have this overhead, we have this expense, but we can't really trace it back to one particular product because the janitors clean the entire manufacturing facility. They're not just cleaning the facility for product A or product B or product C. So those costs, we still need to capture them. We don't want to lose sight of them. We do need to capture them, but we refer to those as indirect costs. And indirect materials and indirect labor, we classify as manufacturing overhead. Direct materials very often could be raw materials. So it could be the purchase of plastic, it could be the purchase of gold, it could be the purchase of steel, or it could be the purchase of wood to assemble desks, for example. So those direct materials we could easily trace to a particular product. Direct labor is the labor cost associated with producing the product. So it's the laborers, it's the wages of the laborers that we incur as an organization to actually make the product. Now that's different from the salaries that we would pay, for example, the plant manager. So plant manager is responsible for running the entire manufacturing facility, which includes product A, product B, product C, product D. So how do we allocate the cost associated with employing a plant manager? So it's difficult to say that the plant manager spent 20% of her time on managing product A. So for example, those salaries that we pay to the plant manager or the assistant plant manager are considered to be manufacturing overhead. It's indirect labor. It's not direct labor. Only direct labor is those laborers that are working in the manufacturing facility to produce the product. Any questions about that? No? Period costs are those costs that are non-manufacturing costs. They're costs that are not associated with making the product. It's after the product has already been produced. So an example of a period cost would be the money that we pay to our sales organization. Let's say we pay them commissions. If we pay them commission and a salary, that's considered to be a period cost. It's a non-manufacturing cost. It's an important role, but what we're going to focus on specifically is product cost. So that's not related to the manufacturing of the product. We still recognize it as a period cost, and very often we refer to it as SG&A, which is selling, general, and administrative. So it is a very significant cost that we are going to capture. It is going to show up on the income statement. In fact, it's a line on the income statement. So we're not ignoring it, but for now we're focusing on making decisions about particular products. So we need to have information about particular products and understand its impact on the profitability of the organization. So to recap, we said that there's manufacturing costs and non-manufacturing costs. The manufacturing costs include direct materials, direct labor, and manufacturing overhead. Manufacturing overhead includes indirect materials and indirect labor. So that's an overview of some of the key terms as it relates to managerial accounting and cost accounting. Because what we want to look at is the impact that these costs have on the organization. Now, another example of indirect material would be, for example, the glue that you might need to make a particular desk. Now think about it. How do you determine how much glue is used to make one particular desk? And if you did find that out, what value does that really add? So you use 1 ounce or you use 1.5 ounces of glue. the impact on the profitability of the product is really insignificant. So instead of spending a lot of time and effort trying to calculate and determine and measure the glue and the cost, which could literally be 3 cents or 4 cents, we still want to recognize that, but it's not worth the time and effort to trace that back to a particular product. But we do capture it as manufacturing overhead. So those costs are not lost or forgotten. Now we need to make a distinction between fixed costs and variable costs. Sometimes students say that fixed costs are costs that are fixed. Well, yes, that's true. But importantly, total fixed cost does not vary with the manufacturing quantity. So whether you make 1 unit or 1 million units or 100 million units, the total fixed cost of the organization remains the same. An example of fixed cost might be, for example, the rent that you pay on the manufacturing facility, or the interest payment, or the money that you're paying on the loan to the bank on the building. You still have to pay those costs, or the real estate tax. All those costs are fixed. They're not going to increase. Total fixed costs are not going to increase if within a relevant range of production. Total fixed costs are not going to increase. They will stay constant. The unit fixed cost will decline as the production volume increases. So what's going to happen with fixed cost absorption is that the more units that you produce, the smaller the amount each unit will have to absorb of the fixed cost. Now variable cost, for example, the unit variable cost will stay the same. So for example, if you need 2 ounces of plastic to make the product, and that costs 58 cents, that's not going to change. If you make 1 unit, or 1 million units, or 100 million units, you're still going to need 2 ounces of plastic to make each unit, and it's still going to cost 58 cents, assuming you're not getting any type of volume discount from the supplier. But what's going to happen is, although the unit variable cost will remain the same, the total variable costs are going to increase, because to make 1 unit, you need 2 ounces. To make 2 units, you need 4 ounces. To make 1,000 units, you need 2,000 ounces. And to make 1 million units, you need 2 million ounces. So the total variable cost is going to increase, but the unit variable costs are going to stay the same. So we need to be able to classify the costs. And that's why we're taking the time to review this terminology. Because the costs that the company is incurring, it's important for us to classify those as fixed or variable. So when we're going to make a decision as a manager, it's important for us to know if the cost is fixed, because that means that we're not going to be able to reduce that cost by making more units. Or conversely, we're not going to be able to avoid that cost if we discontinue a particular product line. Now with variable costs, the opposite is true. So if there's variable costs associated with a particular product, then if we stop making that product, then those variable costs will go away. Now, product cost can be fixed or variable. Period cost could also be fixed or variable. So take, for example, a period cost. A period cost that would be fixed would be, for example, the salaries that you pay to the managers in the sales organization, assuming that there is no variable component, which would be some type of commission as a percentage of sales. A variable period cost would be something like the amount of the electricity that's used in the corporate headquarters or in the marketing department. Now, importantly, electricity in that situation is classified as a period cost. The electricity that we use in the manufacturing facility is considered to be a product cost, and we make a distinction between the two. The same with other costs that may have the same function or provide the same benefit, but one is provided for the manufacturing facility and one is provided for the sales department or the marketing department or the corporate headquarters. Sales, marketing, the accounting department, all of those are functions that reside in the corporate office or the local office, or importantly, outside of the manufacturing facility. So those are non-manufacturing costs. Those are selling, general, and administrative costs. Now, direct labor and manufacturing overhead, the two of those combined we refer to as conversion costs. So the question is, given that we have purchased the raw materials, the question is, what will it cost to convert the raw materials into either work in process or finished goods? So there's three main types of inventory. There's the raw materials, there's the work in process, which is also sometimes referred to as work in progress, and very often referred to as WIP, and finished good inventory, all of which are assets on the company's balance sheet. So we're interested in understanding how much direct labor and how much manufacturing overhead, which includes indirect labor and also indirect materials, will it cost for us to transform the raw materials into a product, either a fully completed product or a partially completed product. So that's referred to as conversion cost. And I'm going to take an example from our book. This is on page 65 of our book. All right, this is about a company called Swift Company. They were organized on March 1st of the current year. After 5 months of startup losses, management had expected to earn a profit during August. Management was disappointed, however. When the income statement for August also showed a loss, the manager decided that since they weren't profitable within the last 6 months, that they would not seek to replace the controller for the organization. However, the president asked that the assistant to the controller prepare the income statement and the schedule of cost of goods manufactured. So keep in mind, as it relates to product costs, these are what we call inventoriable costs. Those are costs that we incur that we don't expense at the time that we incur them. They're expensed at the time that the product is sold. So we need to use this information, the direct material cost, the direct labor cost, the manufacturing overhead cost, to determine what is the cost of goods manufactured, and then use that amount to compute what is the cost of goods sold, which is an important line item on the income statement. But it's something that we need to calculate. So I want to go through an example with you with regard to Swift Company. So right now we're going to begin by preparing the cost of goods manufactured. So this is for Swift Company. And this is the schedule of cost of goods manufactured. This is, in this scenario, we're talking about the month ending August 31st. So we begin by looking at what are the total manufacturing costs. Now remember, we said that manufacturing costs includes direct materials, direct labor, and manufacturing overhead. So that's what we're going to document on this schedule. So we need to compute direct material used in production. So we start by making a note of the raw material inventory as of August 1st. We're told that that's $8,000. So that's the amount of raw materials, could be plastic, could be gold, could be cotton, the amount of raw material that we have on hand at the beginning of the period. To that, we add the raw materials that are purchased. So we realize that an order from Walmart is going to come in, and we need to purchase cotton. We need to purchase plastic to produce, let's say, maybe 150,000 units for them. So what do? We turn around and we purchase $165,000 worth of, let's say, plastic. So that means that if we started with $8,000 worth of raw materials at the beginning of the period, and then we purchased $165,000 of raw materials, that means that the raw materials available for use is $173,000. Now we're told that the ending raw material inventory is $13,000. So what we need to do is deduct the raw material inventory from the raw materials available for use. So this is as of August 31st. So we're told that the raw material inventory at the end of the period is $13,000. And that's going to give us the raw materials used in production. Which in this case is $160,000. So remember now, we're looking at manufacturing costs. So we're starting with direct material, then we're going to look at direct labor, and then manufacturing overhead. We started with $8,000 of plastic at the beginning of the month. We purchased $165,000 worth of plastic. That gives us raw materials available for use of $173,000. But we want to know how much raw materials did we use in the production process? Not just what we have on hand, but how much plastic did we use to produce the order for Walmart and our other customers? So the way that we calculate that is we look at, well, how much raw materials do we have at the end of the month? What is the value? And in this example, we're told that we have ending raw material inventory of $13,000. Well, if we started the month with raw materials available for use of $173,000, and at the end of the month we have $13,000 worth of raw materials, that means that we used in production $160,000 worth of raw materials. Now we're going to look at direct labor and manufacturing overhead, which we don't need to calculate in this example because the book tells us how much we spent on direct labor, which in this case is $70,000. And manufacturing overhead, we're told, is $85,000. So the total manufacturing cost that were incurred in this example is $315,000. That's the total manufacturing cost. $315,000 is the total manufacturing cost. And remember, we said that manufacturing cost includes direct materials, direct labor, and manufacturing overhead. And that's how we calculate the total manufacturing cost. But we're not done, because we still have some work in process inventory. At the beginning of the month, we had some work in process inventory. We started with some partially completed goods, and at the end of the month, we also have some partially completed goods. So we need to add back the work in process inventory at the beginning of the month, which in this case we're told is $16,000. So we add back the beginning work in process inventory, which is $16,000. That gives us $331,000. And then from that, what we have to do is subtract the work in process inventory at the end of the month, the ending work in process inventory balance, which in this case we're told is $21,000. So we subtract that and we get the cost of goods manufactured at Swift Company is $310,000. the cost of goods manufactured. Any questions?
And
yeah, this is what we've done is once we've calculated the total manufacturing cost, the direct material, direct labor, manufacturing overhead, which in this case is $315,000, then what we do is we have to add the value of the beginning work in process inventory. So at the beginning of the month, on August 1st, we had some partially completed goods. The value of that, in this case, is $16,000. So remember, we're tracking the product cost here. So to produce the work in process, we've incurred direct material costs, direct labor, manufacturing overhead, and in this case, it's $16,000. But at the end of the month, we also had some work in process, but we need to understand the net effect. So we started with $16,000 in work in process inventory. At the end of the month, we had $21,000. So the net effect is actually $5,000 of work in process inventory. So in effect, what we're doing is from the total manufacturing cost, we're subtracting the $5,000 of work in process inventory, which leaves us with $310,000 of cost of goods manufactured. Does that make sense? So we have to subtract the work in process because the cost of goods manufactured is finished goods. Because remember, we said that product costs are inventoriable costs. That means that we're not going to record those costs, those expenses, until at the time that it's sold. So what we're trying to do is to get the cost of goods manufactured total so that we could calculate the cost of goods sold, which is a line item. This is just a schedule. This is our schedule. This is our worksheet, so that we could determine what is the cost of goods sold for our income statement. And that's what we're going to do now. We're going to look at an abbreviated version of the income statement for this company. So now that we have the cost of goods manufactured, what we could do is calculate the cost of goods sold based on the information that we're given. Let's see, we'll go on the other side of this, this cord here. Let's see, are we still able to, you could focus the camera over here. So we're looking at Swift Company, and
you need to move a little bit. No, I mean, yeah,
this is their income statement, and this is for month ending August 31st. So the first thing that we put on our income statement is the amount of sales. In this case, we're told in this scenario for Swift Company that for the month of August, they had sales of $450,000. 450,000 US dollars. That's not too bad. You wouldn't mind, as an entrepreneur, having a business that was generating sales of $450,000. But sales are not everything. We need to understand what are our expenses. So we're going to look at the product costs, and we're also going to look at the period costs as well. So we have the product cost information that we need to calculate the cost of goods sold. Now, in this scenario, we're told that the value of the finished goods inventory is $40,000. So the finished good inventory as of August 1st, at the beginning of the month, is $40,000. So we have some product on hand, some finished good that is in the warehouse, and that's valued at $40,000. But now we add in the cost of goods manufactured. So we took the trouble to prepare that schedule, and we need to add in the cost of goods manufactured, which we calculated to be $310,000. This gives us the value of the goods available for sale, which is $350,000. So remember, what we're trying to calculate here is the cost of goods sold. Let's go back here for a second. We found out what the total manufacturing costs were, which includes the direct material, the direct labor, and the manufacturing overhead. We said that we need to net out the work in process inventory because those are partially completed products. What we're trying to find out is the cost of goods sold. Well, presumably you can't sell a product that's partially completed. So in this case, we've taken out the value of the work in process inventory, and therefore the cost of goods manufactured is accurate, and we record that here, and we add that to the finished goods inventory. So we have finished goods inventory at the beginning of the month on August 1st. That's $40,000. That's the value of the finished goods. But we add to that the cost of goods manufactured. That's at the beginning of the month. This is the cost of goods manufactured for the entire month of August. So we started with finished goods inventory. The prior month, whatever we produced, we didn't sell everything. In this scenario, we were left with some inventory. In this case, it's valued at $40,000. Then we went on and we produced product this month. Remember, we said that we bought $165,000 worth of plastic. We produced a lot of units. And at the end of the month, even after starting with $8,000 worth of plastic and purchasing $165,000 worth of plastic, and having, at that point, raw materials available for use of $173,000, so $173,000 worth of plastic, at the end of the month, we still had $13,000 worth of plastic, which means that we used $160,000 worth of plastic to make product. And that's what we're capturing here in part. That's the direct materials. And we've also captured direct labor and manufacturing overhead. So that total is $310,000. And we add that to the finished good, the value of the finished goods from the prior month, which in this case is $40,000. And that gives us goods available for sale of $350,000. But we're not done, because we need to look at the net. Remember, this is the finished good at the beginning of the month. So now we need to subtract the finished goods inventory from the end of the month. So we deduct the finished goods inventory that we had on August 31st. And in this case, we're told that it's $60,000. And that means that our cost of goods sold is $290,000. So we finally got to a point where these inventoriable product costs, these are all product costs, direct material, direct labor, manufacturing overhead. They're not period costs. That's gonna be one of the following line items. So that's our cost of goods sold, which is $290,000. And so we subtract the cost of goods sold from our sales. And that gives us a gross margin of $160,000. But then we have some period costs. These are non-manufacturing costs. So what we've talked about so far is the manufacturing cost, the direct materials, the direct labor, and manufacturing overhead. And we've captured that here in our cost of goods manufactured. But now we need to address our period costs, which are also known as selling, general, and administrative. Those are the non-manufacturing costs. In this case, the selling, general, and administrative are $142,000. So that means for the month of August, we have net operating income of $18,000. What are we capturing here in selling, general, and administrative? Those are all the period costs, all the non-manufacturing costs that we're incurring. So that's the money that we spent on advertising, the money that we paid our managers in corporate headquarters. We said, that's not what we paid the plant manager. The plant manager is part of manufacturing overhead because that's a product cost. But we don't capture that as direct labor. Direct labor is the cost that we pay the people on the manufacturing line, the people that are tightening the bolts on the cars. That's direct labor. And then those costs we could tie back to the Ford Taurus or the Ford Expedition. So we're able to effectively allocate those costs to particular products. But we said that with the plant manager, well, the plant manager runs the entire plant. And the plant manager is responsible for not just the Ford Taurus and the Ford Expedition, but the Ford Focus and other products in their portfolio. So the manager of the plant, that salary expense is captured as manufacturing overhead. And that's part of the cost of goods manufactured. Selling, general, and administrative are all those non-manufacturing costs. We refer to those as period costs. We have to operate the corporate headquarters. That's where we're capturing what we pay the president and the CEO and the accountants. We gotta pay the accountants. They've got to get paid. So their salary is part of selling, general, and administrative. So you see, what we've done is we started off by talking about the different types of manufacturing costs, which we said we refer to them as product costs. The direct materials, direct labor, and manufacturing overhead. The manufacturing overhead, we said, includes indirect materials and indirect labor. The difference is that direct costs, like direct material or direct labor, are costs that we could easily trace to a particular product. Indirect materials and indirect labor are difficult to trace to a particular product. So indirect labor would be, like we said, the manufacturing supervisor, who's a supervisor for the entire plant. or the plant manager. We don't want to lose sight of those. Those costs are important, but we capture that as manufacturing overhead. And those three combined are the total manufacturing cost. And ultimately what we're trying to do by completing the schedule is to determine what is the cost of goods sold. So once we know the cost of goods manufactured, right, you see the difference? So what is actually happening here? What does this tell us? That we made, right, we made $18,000 for the month, but what is the difference between the cost of goods manufactured and the cost of goods sold? So what does this tell us here? Here we said that the cost of goods manufactured is $310,000, but it says that the cost of goods sold, which is this, is $290,000. So the cost of goods sold is $290,000. So let's see, what does that actually indicate? The cost of the goods manufactured. So he manufactured a certain amount of product, that's $310,000, but the cost of goods not manufactured but sold is $290,000. So what happened there? How come those numbers are not the same?
Because all the goods that you manufacture, you can actually sell.
Absolutely. So we have some excess inventory. We have, at the end of the month, we have some finished good inventory. And presumably that we have some work in progress, some partially completed goods, that's already reflected. The net amount we subtracted from the cost of goods manufactured, so that's already been addressed. But this suggests that, as you're saying, everything that we produced, we didn't sell. That's not bad per se. You don't want to make a lot more than what you're going to sell in a given month, but you have to hold some inventory, because what happens very often is you're not able to produce the quantity that you need for a given period in, let's say, a month. So you have certain capacity limitations. So you may need to build inventory for several months. So for example, let's say you're a company that sells giftable items, and in the fourth quarter, during the holiday season, you do a significant percentage of your business. Maybe even 2/3 or 75% of your business is done in the fourth quarter of the year. So what happens is that throughout the year, you're going to be
Still selling.
Yeah, you're going to be selling, but you're also going to be creating inventory that's more than the amount that you're selling. So you have to be able to hold inventory, because when you reach October, November, and you get that huge demand for product, there's very often capacity limitations there's just only so many items that you could make in a given month.
To avoid a shortage in the market also.
Absolutely. So think about, are you familiar with Tickle Me Elmo? It's like some sort of teddy bear or something, right? Stuffed animal. They start making Tickle Me Elmo for the next year in November. So everything that they're making in November in China of these stuffed animals are going to be sold in the next year. Why is that? Because it takes 45 days on a ship for the product to be shipped from China to the United States. Well, if you ship that in November, you're not going to get the merchandise until the beginning of January. What are you going to do with that then? They ship you 50,000, they ship Macy's 50,000 Tickle Me Elmo, and you get that January 10th? What are you going to do with all of those? You miss the season. But what they do is they build the inventory, not Macy's, the manufacturer, and they hold it, because they know once it reaches August, they're going to get an order for 30 million Tickle Me Elmo. Well, you can't make that in a weekend. You have to make it in advance. Now, there's certain trade-offs. You could have, you could increase your manufacturing capability, so you could have more equipment. But let's say you've already reached what you consider to be the maximum. Maybe you already have 1,000 sewing machines, and you have over 1,000 workers stitching these stuffed animals all day long. Does it make sense to open up another facility and hire another 1,000 people and buy another 1,000 sewing machines? That's what we would need to decide. And that's what managerial accounting is all about, is about getting information to make decisions about the future performance of the company. We said financial accounting is focused on the past performance. When you're preparing the income statement, it's about what happened last month or last year. That's the focus of financial accounting. And to analyze those results in a variety of different ways. Certainly the financial statements are one way, but then we could calculate financial ratios as well and do financial statement analysis. But all of that is based on historical performance. Managerial accounting, and what we're talking about today, is about how managers are going to make decisions and the information that they need to make those decisions. So that was the focus of today's lecture. Any questions? Good? You good?
Yeah.
Are you great?
I mean, yeah, this stuff related to accounting, so I didn't know I was going to do it for the
Right, so as entrepreneurs, we need to be the accountant, we need to be the sales manager, we need to be responsible, we're going to be responsible for advertising, because early on, unless we have significant funding, we're not going to be able to hire all these people. So we need to be able to have, understand how to capture the information that we need, the cost in particular, right? We're talking a lot about the cost. We need to know what costs are we incurring so that we could minimize those costs where possible and make the company more profitable. Because it's not just about sales. $450,000. Wow, we were so excited, right? At first we said, oh, yeah, I want that business. Then after everything, what are we left with? $18,000. Now, $18,000 is not insignificant either. That's not, you know, that's not, I remember that's on net income. So presumably, in the SG&A, the selling general administrator, you already paid yourself a salary for the month, but we're left with $18,000. But that's not as impressive as that $450,000 in sales. So what we want to understand is, for example, in another scenario, what would happen if one of the product lines were discontinued? So what about if one of the product lines had sales of $150,000? We need to ask ourselves, should we continue to make that product, or should we discontinue making that product? How is it going to impact the profit of the company? And if we do continue to sell that product, should we make it or should we buy it? In other words, should we outsource it? And we said that, well, it depends what percentage of the costs are fixed and what percentage are variable. Because the fixed costs are not going to go away. So what's going to go away is that $150,000 in sales if we discontinue the line, but the fixed costs are still there. The variable costs are going to go away, but for that particular product line, but not the fixed costs. So we need to evaluate that scenario and similar scenarios so that we can make the right decisions. Just like with the case that we looked at with Su Chin. the grocery store. You need to consider the shelf space productivity of the grocery store. So what items do you keep on the shelf? And if you have an item on the shelf that's delivering $5,000 in sales per month, then we have to ask ourselves, well, what if we took that item off and we put a different item there? How would that impact the profitability of the company? So we'll talk more about cost and profit relationships within an organization. Anything else?